Welcome to the deep dive. Today, we're cutting straight through the noise. We've got a massive stack of sources here.
A big pile.
Yeah, from modern finance stuff to, 19th century industrial battles. And we're pulling out the strategic blueprints, the real ones, used by some of the world's most powerful figures.
Right.
If you want the shortcut, the real understanding of how these huge fortunes are actually built, and maybe more importantly, how they're protected, then yeah, you're definitely in the right place.
And our mission today really is to look at how this kind of raw financial power, strategic power, is actually used globally. We want to go beyond just the shiny success stories and, extract the actual mechanisms, things like technological advantages, financial manipulations, even the sheer psychological force it takes. It's not just about making $1 billion anymore.
No.
It's about building these multi-billion-dollar legacies that frankly reshape entire markets, even governments. We're digging into the key nuggets, you could say, that define how this power works today.
It's a deep dive, all right, into conflict, disruption, leverage, all of it. And we're starting where you almost have to start in the 21st century, the digital frontier.
Yep.
Specifically, these new engines of wealth, technology, data, and this relentless drive for global digital monopoly.
Okay, so if you're looking at where the tectonic plates of power are shifting right now, it's got to be the global race for AI dominance.
Right, yeah.
And that race, fundamentally, it's China versus the U.S.
Yeah.
The scale of ambition, particularly coming out of Beijing, it's pretty unprecedented.
Unprecedented is definitely the word. Because, look, this isn't just China trying to catch up. The sources are really clear on this.
No, it's leadership thereafter.
Exactly, global leadership. It was almost immediate, right?
Yeah.
After that symbolic Go match where Google's AlphaGo beat Kiji.
A huge moment.
Huge. And right after that, the Chinese central government rolls out this incredibly aggressive national plan for AI.
And that plan, it's not vague. It has a very clear deadline, 2030. By then, China intends to be the global center for AI innovation.
Not just applications, but theory, too.
Theory, technology, application, the whole stack. They're aiming for comprehensive dominance. And the financial world, it reacted instantly.
Oh, yeah. A massive flood of capital. The numbers are pretty stark.
Yep.
By 2017, so just a couple of years after AlphaGo, our sources showed Chinese venture capital investors were pouring so much money into AI startups, they accounted for 48% of all AI venture funding globally.
48%. It's staggering.
It really is. They actually surpassed the U.S. in funding volume for the first time that year.
But here's where it gets even more interesting, strategically speaking. It's not just the sheer amount of money.
Okay.
It's the unique advantage China has in data. Now, obviously, they have the quantity, right? More internet users than the U.S. and Europe combined. Massive numbers.
We hear that a lot.
But the quality of the data, that's arguably the bigger deal for training effective AI.
Okay, unpack that for us. Quantity versus quality. We think of Silicon Valley collecting everything, our clicks, our searches.
Right, and that's largely true. Traditional Silicon Valley companies, because they're often driven by advertising models, they mostly gather data about your online behavior.
What I search for, what videos I watch.
Exactly.
Yeah.
What you like, photos you upload. It's great for optimizing digital ads. But Chinese companies, especially the big platform players, they're deeply embedded in gathering data from the, quote, real world.
The O2O thing, online to offline.
Precisely. Online to offline transactions. This ecosystem captures the specifics of physical consumption.
Like what?
Like where you actually bought your groceries, not just that you searched for them, the specific item you purchased, the exact route your DiDi rideshare took, which, physical salon you used for a makeover, the actual meal you ordered for delivery through Meituan.
So much more grounded in physical actions.
Exactly. And because deep learning really thrives on comprehensive real-world inputs, this physically grounded data gives their AI algorithms way more rich data points. It's about actual daily life, physical purchasing intent. They're not just predicting what you might click on. They're optimizing the entire physical chain of commerce and logistics.
And you can see that reflected in the market, right? The valuations of these O2O companies were just huge.
Absolutely huge. Look at the survivors of that really intense O2O competition back then. Meituan Dianping, the platform for everything from meals to movies, it was valued around $30 billion by late 2017.
$30 billion?
And DiDi Chuxing, the ride-sharing giant, hit $57.6 billion, significantly surpassing Uber's valuation at that point.
Wow.
That massive valuation gap really highlights a key strategic point. Better data quality, especially tied to the physical world, translates directly into superior capital value and potentially monopoly power down the line.
Which leads us to another crucial idea about this phase of AI. Our sources suggest it's less about maybe revolutionary discovery right now.
Yeah, more about application.
And more about disruptive application.
That's a great way to put it. The current phase of AI dominance, it's really characterized by applying one fundamental breakthrough deep learning very successfully to lots and lots of different problems.
So the key players aren't necessarily the original scientists.
Not always. Often they're the tinkerers, as one source called them, the engineers, the strategists, the people who figure out how to deploy this incredible power of pattern recognition most effectively in the real world.
Okay, so pattern recognition is the core strength. Let's take a specific field, like medicine. How does that translate? What does that pattern recognition do?
Well, it creates the potential for what you might call a super diagnostician. Think about it. Diagnosis is basically collecting data points, right?
Symptoms, history, lab results.
Exactly. Symptoms, medical history, environment, blood work, and then predicting a correlation to an illness. Deep learning is incredibly good at this. Why? Because it never forgets. If you train an AI diagnostic tool on, say, precise medical records from 10 million cases, anonymized of course, that tool instantly functions like a doctor who's seen tens of millions of diverse cases.
Spotting things a human might miss.
Spotting hidden correlations, maybe counterintuitive links that even experienced human doctors with their finite memories and, localized experience might easily overlook. It has perfect recall of every case it's learned from.
And the implications for places like China, where maybe the top medical expertise is concentrated in just a few big cities.
It's enormous. AI could help standardize and distribute that high-level diagnostic capability almost instantly across the entire country. It's the ultimate scaling mechanism for expertise, and it's fueled entirely by data.
Okay, let's shift gears slightly. From cutting-edge AI back to, well, traditional software. But the mindset, this competition, it's always felt a bit like warfare, hasn't it?
Oh, absolutely.
Our sources paint a really clear picture of this, especially looking at the early days, figures like Bill Gates.
Yeah, for Gates, the ethos seems pretty clear from the sources. Business is war. You fight to win. Every single time, regardless of who you're up against.
And the example that always comes up is that price war against Teamaker.
Like Teamaker, a much, much smaller company that had a really respected word processing program called Right Now.
So Microsoft could have just ignored them, maybe?
Possibly. But Gates saw them as a threat. Any threat to market share, apparently. So he immediately priced Microsoft Word to just crush Teamaker's product, aggressively undercut them.
And the strategy there isn't just about the price itself.
No, it's psychological, too.
Yeah.
It sends a message to every other potential competitor out there.
Yeah.
Even if you're small, even if you're good, even if you're specialized, we will come after you. We will crush you. It establishes this reputation for absolute market enforcement.
Ruthless.
You could say that. And Microsoft's early dominance, it wasn't just ruthlessness, it was also built on some real strategic ingenuity, finding clever shortcuts, often technological ones, to break into markets they couldn't otherwise reach easily.
Like the problem of getting their software onto the Apple II.
Exactly. Microsoft's software was mostly written for the dominant Intel 8080 chip architecture back then, and its associated operating system, CP/M.
Which Apple didn't use.
Right. The Apple II was booming, a huge potential market, but it used a totally different chip, the 6502. Getting the software to run was a major hurdle.
And Paul Allen had this moment of inspiration, right? Like literally while driving with Gates.
Apparently so. A hardware solution to what seemed like a software conversion nightmare.
What was it?
Allen suggested basically designing an expansion card, a physical card that Apple II users could buy and plug into their machine.
Okay.
And this card would actually contain the Intel 8080 chip hardware and the CP/M operating system that Microsoft needed.
Ah, like a bridge.
A physical bridge. Instead of spending months, maybe years, painstakingly translating hundreds of thousands of bytes of code for a completely new system, they created this hardware workaround. And boom, it unlocked this massive Apple market segment almost overnight.
That's clever. Really clever.
It shows that sometimes technological advantage isn't about pure invention. It's about strategic market penetration, finding ways to remove those structural roadblocks.
So the lesson here, whether we're talking 21st century AI giants battling over global data standards or, an 80s software firm figuring out hardware tricks, it seems like the key to enormous wealth often lies in securing control over the fundamental infrastructure, or the distribution layer, be it data pipelines, platform access, operating systems.
And then using aggressive strategies, sometimes predatory ones, to sideline or eliminate anyone who challenges that control.
That control concept, infrastructure control, it transitions us perfectly into the next area. How modern wealth gets extracted, maybe not through inventing something new, but by exploiting the infrastructure of speed itself.
Right. We're moving into the world of high-frequency trading, HFT, and the millisecond advantage.
Okay, this is where things get really wild and, frankly, a little unsettling when you dig into it.
It fundamentally changed the game.
Completely. The financial market infrastructure was revolutionized. Tiny, tiny fractions of time, milliseconds, even microseconds, suddenly became the most valuable commodity in finance.
And the crazy part is, the sources reveal that even the companies providing the infrastructure, like the big telecom carriers, initially, they had no idea how valuable their fiber optic routes were becoming.
They didn't realize what they were sitting on.
Not at first. Traders literally started identifying specific routes based on speed. There's this one example of a Verizon route between Chicago and New York. Traders nicknamed it the gold route.
The gold route? Why?
Because it clocked in at 14.65 milliseconds. Just that tiny microscopic time difference allowed HFT firms using that route to see price changes first and exploit tiny discrepancies across exchanges before anyone else.
It's just astonishing that infrastructure providers had these multi-million-dollar assets, essentially, and didn't even know it.
Yeah.
But the underlying complexity, the very thing that lets this exploitation happen, it was actually boosted by regulations that were meant to fix the market, wasn't it?
Yes, that's one of the great ironies here. Specifically, Regulation NMS, particularly Rule 610.
What was that supposed to do?
Well, the stated goal was good. It was meant to ensure that investors got the best available price across all the competing U.S. stock exchanges. The NBBO National Best Bid and Offer.
Sounds reasonable.
It does. But to achieve that, it effectively forced trading volume to spread out across multiple geographically separate exchanges. It created this huge, complex, fragmented market.
Okay, wait. We need to unpack that. How does a rule designed to get me the best price actually create this, like, multi-billion-dollar loophole for high-speed traders?
It comes down to the speed of light, fundamentally. And the fact that the best price might exist fractionally earlier on one exchange computer than another, even if they're supposed to be synchronized.
Because the signal takes time to travel.
Exactly. Milliseconds. So HFT firms, with their super-fast connections co-located right next to exchange servers, they can see a price change on exchange A, then electronically race ahead of the slower data feeds going to exchange B.
And jump in.
They interpose themselves between the buyer who hasn't seen the price change yet and the seller whose order just hit the faster exchange. They capture that tiny price difference, the spread.
And they do this millions of times a day.
Millions. This arbitrage happening in near invisible time windows? The sources estimate this complexity created by Reg NMS generated an annual windfall for HFT firms, somewhere between, get this, $10 billion and $22 billion.
$10 to $22 billion a year. Just from being faster.
Enough of exploiting that government-mandated market fragmentation faster than anyone else.
And the exchanges themselves, they're not innocent bystanders here, are they? They're actively profiting from this speed race.
Oh, absolutely. They know the HFT firms are driven by one incredibly powerful emotion, the fear of being slower than their competitors.
They're milking that anxiety.
Totally. Milking anxiety for pure profit. They charge absurd amounts of money for minuscule speed increases. We found figures where exchanges jacked up the monthly fee for just a 2 microsecond speed improvement in the data connection.
2 microseconds, like millionths of a second.
Millions. They raised the fee from $25,000 a month to $40,000 a month for that tiny edge.
Wow.
It's a perpetual arms race that the exchanges are perfectly happy to facilitate because any lead one firm gets must be matched instantly by all the others. It guarantees constant revenue streams for the exchange.
And the whole system feels intentionally opaque, right? Designed to favor these sophisticated, super fast players, like the weird order types they requested?
Yeah, that's another layer. HFT firms specifically requested and received special order types that allowed them to place bids or offers at prices like 30.001.
10,000ths of a penny? What's the point of that?
Priority. Market rules often dictate that the tiniest price improvement gets priority in the queue. So by bidding just 0.0001 higher than a regular investor trying to buy at around $30.
They jump the line?
They jump the line. They get filled first. It's this incredibly granular mechanism of exploitation. Opacity and fractions of a cent are leveraged to systematically short-run ordinary investors, adding these invisible costs and frictions to the entire market.
So the core insight seems to be, if you control the infrastructure early, whether it's fiber optic cables or exchange rules, you can essentially levy a kind of monopoly rent later on. It doesn't really matter what industry you're in.
Exactly.
Yep.
Which makes it fascinating to connect this all the way back, say, a century and a half to someone like John D. Rockefeller and the railroads.
Right. The mechanism feels oddly similar, doesn't it? The technology is different, oil barrels versus data packets, but the game is infrastructure control.
Rockefeller understood leverage and infrastructure control maybe better than anyone in his era. In 1877, he took on the Pennsylvania Railroad.
Which was, what, the most powerful corporation in America at the time?
Arguably, yes. A behemoth. He saw their resistance to Standard Oil's demands as a direct challenge to his control over oil refining and transport.
And his response wasn't just, like, complaining. It was a full-on strategic assault.
A masterclass in coordinated pressure. He didn't just passively refuse to ship oil on their lines. No, he threatened to divert all Standard Oil shipments to rival railroads.
Ouch!
He idled his refineries in Pittsburgh, creating immediate economic pain in their territory. And he ordered his huge Cleveland operations to just fiercely, aggressively undersell the Pennsylvania Railroad's own affiliated pipeline competitor, Empire, in every single market they operated in.
Total economic warfare.
Absolutely. And the leverage was undeniable. He simultaneously forced the other major railroads, the Erie and the New York Central, who were already kind of cooperating with him, to trim their rates even further, just tightening the screws on the Pennsylvania Railroad until they completely buckled.
And didn't one of their own officials basically admit defeat?
Yeah, the ultimate confession. A.J. Cassatt, a top Pennsylvania Railroad official, admitted they were eventually forced to grant rebates to Standard Oil that were so large they were, and I quote, literally paying shippers to transport their oil.
They paid Rockefeller to beat them. That's leverage.
That is the definition of perfect leverage. Controlling the distribution network so completely that your competitor pays you for the privilege of losing money to you.
Incredible. And it also shows his willingness to use personal resources for strategic gain, right? Even when his partners maybe didn't agree.
Yes, that's another key point. Standard Oil often operated by committee, by consensus. But Rockefeller, on his own account, personally borrowed several $100,000, a huge sum, then to buy a fleet of lake transport vessels.
Were they profitable?
No, apparently they were losing money. But their purchase wasn't about short-term profit. It was dictated by the larger strategic interest of controlling all aspects of oil transportation infrastructure. Even if his partners couldn't immediately see the financial sense, he was willing to take on personal risk to enforce that total strategic control.
Calculated personal risk for long-term dominance.
Okay, so moving from that kind of industrial monopoly building, let's look at how wealth gets built in, say, emerging economies, where the interplay between business and politics is often much more explicit.
Right. We enter the world of what's often called crony capitalism, where political connections aren't just helpful, they're often the core asset.
The sources talk about this being pervasive across places like Southeast Asia, right? They even have specific local terms for it.
They do. You see terms like kukong in Indonesia. That describes a situation where a wealthy tycoon, who is often politically dependent, explicitly cuts in politicians or the military for a share of the profits from, say, a monopoly or a government contract.
So it's a direct kickback system, essentially.
In many cases, yes. Or you hear about crony capitalists in the Philippines, or the Alibaba operations in Malaysia, Ali referring to the Malay political figure, Baba to the ethnic Chinese businessman fronting the operation but sharing the spoils.
Different name, same basic system? Pretty much. It's a system where political access and protection are the most valuable commodities, often more valuable than innovation or efficiency.
And this plays out in specific relationships, like the one between Indonesia's Lim Sio Leong and Malaysia's Robert Cook. Both big figures, both originally from China's Fujian province. You'd think natural allies.
Well, yes and no. They were often presented as part of this powerful overseas Chinese network. But the sources describe their partnership, particularly over huge national monopolies like sugar and flour in Indonesia, as more of a forced marriage of convenience.
Force.
Meaning it wasn't necessarily born out of deep trust or mutual respect, but out of political necessity. They needed each other, and the political patrons behind them needed the arrangement to consolidate control over these critical national resources.
So what happens when the political winds shift? Or when economic pressure builds. Does that network loyalty hold up?
Not according to these accounts. Loyalty seems to evaporate instantly when self-interest dictates.
For instance?
For instance, Robert Koch eventually sold off his Indonesian interests because, apparently, he became convinced Liam was systematically cheating him out of his share of the profits.
Okay.
And then, fast forward to the Asian financial crisis in the late 90s, Liam Siolang's massive Indonesian conglomerate collapsed spectacularly.
Right.
Did his supposed network allies, the ones who benefited from the system alongside him for decades, rush in to help?
Let me guess. No.
Quite the opposite. The sources state that figures like Koch explicitly refused to loan him money. In fact, some former associates were reportedly asking for absolutely predatory interest rates like 70% if you wanted emergency funds.
70%. So much for loyalty.
It's pretty brutal confirmation. In this high-stakes world, at least as depicted here, networking is purely transactional. Loyalty is extended only as long as it serves the immediate political or financial stability of the alliance. When the chips are down, it's every man for himself.
Okay, so we've laid out some foundations, controlling infrastructure, data, political systems. But we need to get into the psychology driving these hyper-successful figures.
Yeah, the mindset.
Because for a lot of modern tycoons, especially in tech, success isn't just profit anymore. It's almost like proving their status through constantly escalating valuation.
Exactly. So what does this all mean? It means valuation stops being just a financial metric, right? It becomes intensely personal, a measuring stick.
And Adam Newman at WeWork is kind of the poster child for this.
The quintessential example, yeah.
Yeah.
His entire sense of self, his identity seems to become completely wrapped up in WeWork's valuation number.
The need to be seen as this visionary tech titan was everything. When WeWork hit that $10 billion mark, our sources point out it was explicitly framed, often by Newman himself, as being ranked ahead of established unicorns like Spotify, which was maybe $8.5 billion then.
Right. He needed that comparison.
Oh, he needed that public metric. It seemed to feed directly into, well, what the sources describe as deep insecurities and a narcissistic need for constant validation. Proof that he belonged at the absolute top of that global startup hierarchy. The number itself seemed more important than whether the underlying business actually, worked.
In this psychological need, this imperative, it drove some really strange decisions, both internally and externally.
Like trying to buy Lyft?
Yeah, his obsession with founder-led companies and maybe his own ego led him to seriously try and buy Lyft.
Even though Lyft was a direct competitor to Uber.
Which was a massive investment for his own primary backer, SoftBank. It made no sense strategically for WeWork or SoftBank.
So why do it?
The interpretation in the sources is that he perhaps wanted to signal his disdain for Uber after its co-founder, Travis Kalanick, had been forced out. Newman seemed to prefer that kind of autocratic founder-in-charge model. It showed his preference for absolute control.
Predictably, SoftBank shut that idea down fast.
Very fast. But it reveals the mindset. And internally, this disregard for basic business principles created massive governance nightmares. Like WeWork's internal property fund, WPI.
Described as a tangled knot of conflicts of interest.
A perfect description. It's the classic example of self-dealing. You had WeWork, the company, essentially on both sides of every single property deal.
How does that work?
Well, one WeWork entity, WPI, would be the landlord, naturally wanting the highest possible rent for a building it bought. And another WeWork entity, the main operating company, would be the tenant in that same building, wanting the lowest possible rent.
Negotiating with itself?
Negotiating with itself. It's a financial and ethical mess waiting to happen. It pretty much ensured that decisions were skewed towards maximizing Newman's personal gain through the property holdings and bolstering that overall valuation, rather than serving the actual fiduciary interests of WeWork as a whole.
Okay, let's talk about management style. Because many of these empires built by these hyper-successful figures seem to be run by very autocratic CEOs, ruling by intimidation almost.
Yeah, force of will seems to be a common theme.
Yeah.
Take Elon Musk. He's often described, maybe metaphorically, as being like a bear.
A bear.
Playful, funny, incredibly charismatic 1 minute, but fundamentally a powerful, unpredictable, strong-willed force. Someone who is, as one source put it, completely comfortable asking for trouble.
Meaning he thrives on conflict.
Or at least isn't afraid of it. His style demands absolute loyalty, absolute deference, and the rapid, sometimes contradictory policy shifts we see in his companies. He creates this atmosphere of permanent unpredictability. Employees are constantly on edge, trying to anticipate the next U-turn.
And then you have figures like Steve Cohen back in his SAC Capital days. The whole structure of the firm seemed designed around his centralized power and his legendary intensity.
Absolutely. The SAS model was deliberately structured not for collaboration. Trading teams rarely shared ideas with each other.
Really? Why not?
Because they reported their best ideas directly, and only, to Cohen. He acted as the central hub. He'd synthesize all this incoming information from different pods and then trade on that aggregated insight himself.
Giving him the ultimate information advantage.
Exactly. A comprehensive view nobody else had. And if a trader messed up, especially for what Cohen considered a stupid reason, his anger was apparently legendary. The sources use phrases like, hard to describe in human terms. Traders got paid like star athletes, but they could have dumped as quickly as a bad investment if they lost money or crossed him. The price of admission to that world seems to have been total emotional submission to his volatility.
And we see that same dynamic, maybe even amplified, in the Theranos story. Elizabeth Holmes was the public face, the visionary.
Right.
But the day-to-day operations, the internal culture, that was largely driven by Sunny Balwani.
Yeah, Balwani. Sources consistently describe him as running the firm through outright intimidation, a dishonest bully, feared by the staff.
And that environment allowed the deception to continue.
It fostered a culture of extreme secrecy, fear, and exaggeration. Holmes' public claims like getting comprehensive blood test results in under 30 minutes had to be constantly walked back internally. It became results in 4 hours or less, which still wasn't true for most tests.
Still a huge gap.
A huge gap. And the fact that Holmes and Balwani were secretly romantically involved just added another layer. It blended personal control with business control, making it virtually impossible for any kind of internal dissent or normal governance to challenge the narrative.
Okay, so beyond management style, there's maybe the ultimate form of power. Not from a stock price, not from an org chart, but the ability to just leverage personal influence in the shadows, to manipulate outcomes with no paper trail.
This is raw personal leverage within that elite network. And the sources give a really striking, chilling example involving Jeffrey Epstein.
Okay.
It involves a major fund manager, Warren Kramer, who had apparently lost a substantial amount of money for a very prominent client, Alan Dershowitz.
Right.
Now, how was this resolved? Not through lawsuits, not through formal demands or angry letters.
How then?
Instead, Jeffrey Epstein simply appeared, unannounced, in Kramer's Midtown Manhattan office.
Just showed up.
Just showed up.
Yeah.
And delivered a very direct, very unambiguous message. No threats spelled out, but the implication was clear. He told Kramer, quote, "It's very much in your interest to make Alan Dershowitz whole."
Wow. That's direct.
It's pure calculated influence, using implicit threat, personal standing within that network to ensure a favorable and, importantly, completely untraceable financial outcome for someone connected to him. It bypasses all the normal legal and financial channels.
So the takeaway here is that this kind of immense wealth doesn't just buy resources. It can provide the psychological license for autocratic behavior, often intimidating behavior.
Yeah.
And it's supported by a network that seems willing at times to enforce its will completely outside standard legal or financial norms.
That seems to be the implication, yes.
Okay, we've looked at the micro-strategies, the corporate battles, the psychology. Let's zoom out now to the big picture. The fundamental, structural, economic forces that might be underpinning this relentless concentration of wealth we keep seeing.
Right. And for that, we really need to talk about the work of the economist Thomas Piketty and his central finding, often summarized by that little formula.
R is greater than G. Okay, break that down for us. What do R and G actually stand for here?
It's actually surprisingly simple, but the implications are huge. So R stands for the average annual rate of return on capital.
Meaning what? Stocks, bonds, real estate?
Exactly. Investments, assets, stocks, real estate, businesses, anything that generates returns based on ownership of capital. And G stands for the economy's overall growth rate.
Like GDP growth?
Mostly, yes. The growth in national income and output, which, importantly, tends to reflect the growth rate of labor income, wages, and salaries for most people.
Okay, so R is return on capital, G is growth of the economy, mostly wages. What's the significance of R being greater than G?
Piketty argues, very persuasively, based on centuries of data, that this inequality, the rate of return on capital consistently exceeding the overall economic growth rate, is the fundamental force driving divergence, driving the widening gap in global wealth distribution.
Can you put that in more practical terms?
Sure. Think of it this way. Third EGL lever basically compares how fast your wealth grows if you own assets. your stock portfolio, your rental property, versus how fast your income grows if you rely on your job, your salary or hourly wage.
Okay.
If the return on existing capital is consistently higher year after year than the growth rate of the overall economy and wages, then inevitably the wealth held by the owners of capital will grow faster than the income earned by those who rely primarily on their labor.
The gap just widens automatically.
And becomes structurally inevitable over time.
And the effects are bigger than they seem. Even small percentage differences matter.
Hugely. The effects are exponential. Our sources, drawing on Piketty, detail how even a seemingly small decline in the long-term growth rate, say, it drops from an average of 2% a year down to 1.5% a year, can drastically change the structure of the economy over decades.
How so?
That small slowdown in growth causes the capital-income ratio, which Piketty calls beta, to rise significantly. Beta is the total value of all the capital in a country divided by its annual national income.
So how much wealth exists relative to annual earnings?
Exactly. So if growth slows, beta might rise from, say, 6 years' worth of national income up to 8 years' worth. What does that mean practically? It means that capital owners, collectively, end up controlling a much larger slice of the total economic pie relative to national income.
And this feeds directly into how national income gets split between capital and labor.
Precisely. The share of total national income that goes to the owners of capital, Piketty calls this alpha, is simply the rate of return multiplied by that capital income ratio.
Okay, give us an example.
Sure. If the total capital stock is worth 6 years of national income, and that capital earns an average return of 5% per year, then alpha is 6 times 5%, which is 30%.
So 30% of all income generated that year goes to capital owners.
Right. The other 70% goes to labor. But when thrall stays high and the Shay slows down, beta increases. And if beta increases, then capital's share automatically goes up, squeezing labor's share, even if the rate of return doesn't change.
And this is where Piketty warns about the inegalitarian spiral.
Exactly. This is the core danger. If the difference between trawler and filer gets large enough and stays large enough, wealth inequality can potentially increase without any natural limit.
How does that spiral happen?
It happens because the very wealthy, who get most of their income from capital returns, not salaries, tend to save a much larger fraction of their income than everybody else.
They reinvest it.
They reinvest a large portion. So if their savings rates are high and the return on their capital remains significantly higher than the overall economic growth rate, their pile of capital grows much, much faster than the economy as a whole. It compounds relentlessly.
Like in historical periods.
Yeah, Piketty shows this clearly in places like Belle Époque, Paris, around 1900. The largest fortunes increasingly belonged to older individuals who inherited wealth and saved aggressively. Their capital just grew automatically, faster than wages, leading to extreme concentration. It becomes a self-accelerating structural inequality built into the math of two interlets.
Okay, so this structural force concentrates wealth, and that concentrated wealth inevitably translates into political power, political leverage.
Absolutely.
Often exercised through channels that look like philanthropy, but according to some sources, function more like dark money, aimed at achieving very specific, often self-serving policy outcomes.
Yes. The sources we looked at highlight the rise, particularly in the U.S. over the last few decades, of a new generation of extremely wealthy, often arch-conservative families. Names like the Kochs, Scaife, Olin, DeVos, Coors come up repeatedly.
And they're pouring money into politics.
Vast sums. But often in ways designed to obscure the source. Pouring money into a complex network of think tanks, advocacy groups, academic programs, and media outlets, all aimed at influencing American politics, policy debates, and ultimately voting patterns. Frequently with very little public disclosure about where the money originates.
So it's not just random donations, it's strategic.
Highly strategic. The critical point made in the sources is that this funding isn't piecemeal. It forms a fully integrated network. It's coordinated, often intentionally shrouded in secrecy behind layers of nonprofits, and frequently presented under the positive banner of civic engagement or philanthropy.
Making it hard to trace.
Leaving almost no clear money trail that the public or regulators can easily follow. It's described as a calculated deployment of capital specifically designed to purchase desired policy outcomes.
And are those outcomes often self-serving for the donors?
Well, the sources certainly argue that. Charles Koch, for example, is quoted publicly framing his strong support for slashing corporate taxes and regulations as being motivated by a deep concern for the poor.
Arguing they suffer most from bigger government.
Right. But the sources then point out that the material reality of those tax cuts is a disproportionately massive financial windfall for the wealthiest individuals and corporations, including Koch Industries itself.
And there was that reaction to the private jet loophole discussion.
Exactly. A moment of revealed preference, perhaps. When closing tax loopholes, specifically benefiting private jet owners, was discussed, the Koch network reportedly reacted with absolute fury, betraying the scale of direct self-interest involved, according to these analyses.
There's also a really telling anecdote or interpretation in the sources about how specific policy pushes can be essentially laundered through this network to serve direct corporate interests, specifically around the Kochs and criminal justice reform.
Yes. This is presented as a fascinating case study. The Kochs became quite visible and influential champions of bipartisan criminal justice reform in recent years.
Which sounds positive on the surface.
It does. But the sources emphasize the timing. This major push into criminal justice reform activism gained significant traction after Koch Industries itself faced serious criminal charges.
What were the charges?
Major environmental crimes. Back in 2000, the company was indicted for allegedly covering up the illegal release of vast quantities of benzene, a known carcinogen from a refinery in Texas, described as hemorrhaging benzene into the air. They eventually pleaded guilty to related charges and paid a $20 million fine.
Okay, so they face environmental crime charges and fines, and then become champions of criminal justice reform.
That's the sequence highlighted. The interpretation offered is that this was in part a masterful public relations move, a way to spin a corporate scandal and fine into a narrative of social concern and reform.
But with an ulterior motive.
The argument presented is yes. Crucially, the type of criminal justice reform they heavily funded and advocated for was often focused on weakening the government's prosecutorial power, raising intent standards for corporate crimes, and generally reducing regulatory enforcement capabilities.
The very powers that had just been used against them.
Precisely. The powers that had charged and fined Koch Industries just years earlier. So it's presented as a prime example of using immense financial power, cloaked in the language of social good, to reshape the legal and regulatory environment in a way that directly protects their corporate assets and operations from future accountability.
Okay, let's try to wrap this up. This deep dive has taken us across centuries and industries, but some core strategies seem remarkably consistent.
They really do.
We've seen how controlling the underlying infrastructure, whether it's 19th century railroads or 21st century data flows and financial plumbing, is key. The convergence of global data and AI, especially the Chinese model leveraging real-world transactions, is just the latest iteration of that.
And we've analyzed the enduring power of exploiting the rules of the game, manipulating the market. Whether that's using 10,000ths of a penny to jump an HFTQ or forcing a competitor railroad to literally pay you to ship your oil, it's about finding and pressing every advantage.
Then there's the psychology. That drive for autocratic control, the obsession with valuation as a personal scorecard we saw with figures like Neumann, the management by intimidation seen at places like SAC or Theranos.
Yeah, the human element is crucial.
And underpinning it all, that structural force identified by Piketty, one of Gialer's, the mathematical tendency for capital wealth to grow faster than labor income, creating this widening divergence.
Which then fuels things like the highly organized, often secretive efforts by wealthy networks, like the Koch network described in the sources, to use dark money philanthropy to lock in policies that ensure capital accumulation continues to be favored over labor. It's a feedback loop.
So the core lesson seems to be, whether you're Rockefeller using personal capital strategically to gain control of lake vessels, or an HFT firm exploiting regulatory complexity and anxiety for microsecond advantages, the accumulation and, importantly, the maintenance of extraordinary wealth often seems to require extraordinary conflict, maybe manipulation, or at least the savvy leveraging of political and regulatory structures. It's rarely a gentle process.
No, it certainly doesn't appear to be based on this material.
And these forces we've discussed today, power of data, the influence of dark money, they aren't just abstract economic theories or historical anecdotes.
No, they're playing out right now.
They're actively shaping our world, constantly being leveraged by the very kinds of people and systems we've analyzed, widening that gap between those who primarily own assets and those who primarily earn a salary.
It's the reality of the modern economy.
So the final question, the provocative thought we want to leave you, the listener, with is this. In an economy increasingly defined by this dynamic, by RegEU, where you really need strategic thinking just to see the forces at play, How do you personally position yourself? How do you ensure that you can somehow benefit from this rising tide of capital rather than finding yourself merely subsidizing it with your own labor?
That's the challenge, isn't it?
Yeah.
Something to really think about.